Welcome to the deep dive. This is where we take, well, a whole stack of information articles, research, our own notes, and really boil it down.
Yeah, we extract the crucial bits, the insights you actually need.
Exactly. The goal is to get you well-informed, fast, cutting through all that noise out there.
Get you up to speed quickly.
Today, we are plunging headfirst into the pretty high-stakes world of solar energy. We're doing a deep dive into SunPower, ticker symbol SPWR.
And this isn't just any company profile. It's a pretty gripping story.
It really is an industry giant that basically faced collapse. And now there's this new entity rising dramatically from the ashes. So for you, our listener, the central question is, well, it's stark. Can a proven corporate captain, a real turnaround artist, actually resurrect this fallen solar giant?
And navigate it through what is, frankly, an industry storm right now.
Right. Can they create immense value from what was a really distressed situation?
Yeah.
Or is this a classic value trap?
Where, the compelling story maybe masks some really big external risks and, let's face it, a legacy of failure.
Mm-hmm.
That's right. So our analysis today, we're going to dissect SunPower's revitalized business model, its very unique management approach under T.J. Rogers.
We'll get into him later.
Oh, yeah. We'll look at its current financial health, where it sits competitively in this, tumultuous market, and definitely its risk profile. Lots of risks.
We've synthesized a huge amount of data, really trying to give you that comprehensive understanding.
And just so we're clear, this analysis is current as of June 20, 2025. All the stock metrics, they reflect the June 18th, 2025 closing price, which was $1.58 per share.
Okay. And before we dive in, just a quick note. If you find this deep dive valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel.
It really helps us out.
It does. And for members, it's just $4.99 a month. You get priority deep dives on the tickers you suggest in the comments.
So you get to pick the next deep dive, potentially.
Exactly. And definitely stick around to the end, because we will be teasing our final conclusion on whether this company is truly a phoenix rising or, just more ashes.
It's a big reveal.
All right, let's unpack this thing. We're going to kick off with just a foundational understanding of the company itself. So announcing clearly and distinctly, Chapter 1, Business Analysis.
Okay, so the new SunPower. Its core business model now is pretty squarely focused. It's a vertically integrated residential solar services provider.
Primarily North America.
Primarily North America, yes. And they're really aiming to offer that end-to-end customer experience, from the first chat.
Consultation, design.
Right. Consultation, system design, all the way through installation, and importantly, long-term maintenance.
Trying to make it seamless.
That's the idea. As integrated as possible for the homeowner.
And it's really crucial to understand this isn't just a quick paint job or rebranding. This is a radically restructured company.
Totally different underneath.
Yeah. What happened was Complete Solaria, which was, frankly, a smaller player,
Much smaller.
acquired key assets from the original SunPower Corporation after it filed for Chapter 11 bankruptcy back in August 2024.
And those key assets were pretty valuable.
Oh, yeah. The SunPower brand itself, which is huge, the Blue Raven Solar Installer Network, their new homes division, and that established dealer network. Big pieces.
And then, just recently, April 2025, Complete Solaria officially took on the SunPower name and the SPWR ticker.
Made it official.
Right. So their primary revenue streams now, it's direct sales of solar and storage systems.
Storage is key.
Storage is increasingly key, yes. Then the actual installation and related services, you often hear EPC, engineering, procurement, construction, and ongoing O&M, operations and maintenance. They use a hybrid model, working with third-party partners, but also having their own installation teams.
And financing, that's changed too, right?
But change. They facilitate financing solutions now by partnering with external lenders. SunPower itself hasn't offered new leases or PPAs, power purchase agreements, since July 2024. They're out of that direct financing game.
Interesting shift. Okay, products and services. Their flagship is that integrated SunPower Equinox system.
That's the one. Marketed as all-in-one. It's designed to be a complete, cohesive system for the home.
And they still leverage the high-efficiency panel legacy.
They do, but now it's through partnerships. Often using Maxon technology, Maxon was actually spun off from the original SunPower.
Right, I remember that.
And crucially, like you said, storage. They've got a strong partnership with Enphase Energy for their 10C and 5P battery solutions.
Which is vital for backup, managing peak demand, and dealing with things like California's NEM 3.0.
Absolutely. NEM 3.0 basically changed the economics of solar in California, making batteries much more valuable for homeowners.
You almost need them now in some places.
Pretty much. And one thing that's really fascinating, a big differentiator, is their complete confidence warranty.
Ah, yes. Tell us about that.
Well, unlike many competitors where you might get separate warranties for panels, inverters, labor, it gets complicated.
Yeah, stack of paperwork.
SunPower offers a single, comprehensive 25-year warranty. It covers the entire system,
Including labor and shipping.
including labor and shipping. That's a rare level of commitment, real peace of mind for the customer.
That does sound compelling. So SunPower is positioned as a leading U.S. residential provider, but the scale is totally different now, isn't it?
Oh, completely. The old SunPower had, what, around 3,500 employees?
Something like that.
New management came in, boom, cut the workforce by roughly 75%, down to just 906 employees by Q1 2025.
Just drastic, but necessary for the turnaround.
Absolutely necessary, according to them. It means they're now structured to actually be profitable at an annualized revenue run rate of around $300 million.
Which is a fraction of the old stale.
A fraction. But it's lean, it's agile, and importantly, they still have that powerful brand recognition from the old SunPower's huge customer base, over 500,000 customers.
That's a massive asset to inherit.
Huge. So their value proposition really rests on three pillars. One, superior quality and performance. Two, that end-to-end simplicity and peace of mind, like the warranty. And three, brand trust and sustainability. They leverage that nearly 40-year history and their cradle-to-cradle certification.
That's the one about environmental and social responsibility through the product life cycle.
Exactly. It appeals to consumers looking for reliability and an ethical choice.
Okay, so that's the company itself. Now, let's zoom out to the industry. Long term, the U.S. residential solar market. Growth still looks pretty good.
Yeah, projections are quite robust, something like 9% to maybe 14.4% compound annual growth through 2030.
Driven by what, mainly?
Primarily steadily rising electricity rates, that's a big one, and just increasing demand for energy resilience. People want backup power, especially with battery storage becoming more common.
Makes sense. But the short term, that's a different story, isn't it?
Completely different. This is where it gets really interesting, connecting the dots. Despite that long-term optimism, the industry is facing, well, severe short-term headwinds.
We saw contraction last year.
Yeah, the market actually contracted in 2024 and early 2025. Residential installs fell 13% year over year in Q1 2025.
Why? High interest rates.
That's a huge part of it. High interest rates make financing more expensive for homeowners, plus broader economic uncertainty.
And that's led to consolidation.
A wave of it. Consolidation and outright failures. Around 70 solar companies went out of business in 2023-2024.
Wow.
But here's this strategic angle. While this shakeout is painful, it actually presents an opportunity for companies that are well-capitalized and efficient, like potentially the new SunPower.
Right, positioned to pick up the pieces. The competitive landscape is fragmented, you mentioned.
Highly fragmented. You've got the big national players like Sunrun, they're a major competitor, often using that TPO model, third-party ownership, leases.
Different from SunPower's direct ownership focus now.
Exactly. Then there's Sunnova, which is frankly facing severe financial distress itself.
Another potential target, maybe?
Could be. SunPower differentiates with that direct system ownership push and strong partnerships, like with Enphase for components.
Okay, but looming over all of this is the regulatory environment. Huge external threats here.
Massive. The investment tax credit, the ITC, that crucial 30% federal subsidy.
Yeah.
It's under threat. There's talk of a phase-out by the end of 2025 under this one big, beautiful bill. Losing that would be significant.
It would dramatically increase the cost for consumers.
Exactly. Then you've got punitive U.S. import tariffs on solar cells and modules from Southeast Asia, where over 80% of U.S. imports come from.
Increases their costs directly.
Increases cost of goods sold, yeah. And while the IRA, the Inflation Reduction Act, offers domestic manufacturing incentives, progress has been slow, especially upstream, like cells and wafers.
So even with companies failing, it's still hard to get into this market. High barriers to entry.
Still significant barriers, high upfront capital costs, incredibly complex supply chains and logistics.
Yeah.
You need deep regulatory and permitting expertise.
And building trust.
Especially in a market that's seen failures. It's a formidable task.
So what are SunPower's competitive advantages, their economic moat in this tough environment?
Well, several key things. First, brand strength. That SunPower name is globally recognized, nearly 40 years old. That cradle-to-cradle cert helps too. Trust is huge.
Okay.
Second, Radical cost advantages.
Mm.
Post-bankruptcy, they are lean. That low operating break-even, around $72 million quarterly revenue, is absolutely critical right now.
Built for survival.
Potentially. Third, network effects and switching costs. That integrated Equinox system, the single warranty it creates, stickiness. Customers are less likely to switch providers or piecemeal solutions.
Makes sense.
And finally, unique assets capabilities. Over 1,000 patents inherited, the all-in-one system itself. And you really can't overstate this in this situation.
The leadership.
Visionary leadership. T.J. Rogers. In this specific turnaround, he is arguably the primary asset.
That paints a really clear picture of the battlefield, and it makes SunPower's position really interesting. They seem structured to survive, maybe even thrive in the storm that's sinking others.
That's the bet.
Yeah. A high-stakes wager, leveraging that legacy brand on a super lean structure, perfectly tailored maybe to exploit consolidation, but hugely vulnerable to those external pressures. Wow.
Exactly.
Okay, let's keep moving. If the company's success hinges on this turnaround, it really often comes down to the leadership. So let's shift focus. Announcing clearly and distinctly, Chapter 2, Management Evaluation. This is where the story gets its main character.
Absolutely. And T.J. Rogers is truly the core of the investment thesis here. You can't really analyze SunPower now without focusing on him.
His track record is pretty legendary in tech circles.
It is. Founded Cypress Semiconductor, CEO there for 34 years. He also personally invested in and guided the original SunPower through growth phases years ago.
So he knows this company, this industry.
Deeply. And perhaps most relevantly, he successfully turned around Enphase Energy, another key player in solar inverters, batteries. He knows this space inside out.
And his strategy now, this arc theory, wonk,
Right.
It's bold.
It's incredibly bold. The idea was basically salvage the most valuable assets from the old SunPower's bankruptcy, like building an ark to survive the flood.
Using complete Solaria as the vehicle.
Right. Acquire the best bits, brand, network, and then immediately just ruthlessly cut costs. That 75% workforce reduction.
Which led to profitability within 2 quarters.
Operating profitability, yes. Which is, frankly, astonishing given the industry headwinds. A real feat of execution.
And he brought back some key people, too.
He did. SunPower's original founder, Dr. Richard Swanson, is back as an advisor. And Dr. Marin Sethi, who was instrumental at Enphase, particularly in batteries, is the new CTO.
Signaling a return to technical focus.
Exactly. Restore technological leadership, operational excellence. That seems to be the message.
His communication style, direct is an understatement.
Exceptionally direct. Confident. He's been incredibly candid about the ARC theory, the layoffs, everything in shareholder communication.
And his views on subsidies are well known.
Oh, yeah. He famously dislikes what he calls solar welfare programs. Believes they foster inefficiency. He's a staunch free market advocate. Ethically, that's his reputation. Results, shareholder value.
But we do have to acknowledge the baggage from the old SunPower, right? The ethical clouds.
Absolutely. You can't ignore it. Before bankruptcy, there was that accounting scandal, an SEC subpoena. The CEO resigned. The auditor left.
That doesn't just vanish.
No. The new team has to work really diligently to overcome that stain on the brand's reputation and rebuild trust. It's a shadow they have to emerge from.
Okay, so capital allocation under this new regime, all about growth.
Squarely focused on growth and reinvestment. No
Yeah.
dividend, no share buyback program currently.
Plow back in.
Plow back into the business. Strategic hires like the new tech leaders, and definitely gearing up for future acquisitions.
Which brings us to the M&A strategy. It sounds aggressive.
Extremely aggressive. Rogers has explicitly stated his intent.
Whoa.
Be a consolidator. Buy distressed competitors, especially if that ITC phase-out happens and creates more carnage.
And shareholders seem on board. They approved a big stock plan increase.
They did. A large increase in the employee stock plan, signaling readiness for future equity-based acquisitions. It shows the alignment. The existing shareholders understand and support this M&A-driven growth vision.
It's a stark contrast to the old SunPower's track record with capital, isn't it? Return on invested capital.
Abysmal. Consistently negative ROIC for a decade. Yeah. Just destroying shareholder value, unfortunately.
So the ARC theory is designed to structurally fix that.
That's the core idea. Acquire assets cheaply out of bankruptcy, shed the old liabilities. That Q1 2025 profitability, even if small, is the critical first proof point that capital might finally be deployed productively. A huge reversal.
So wrapping up management, the investment thesis really is a bet on Rogers.
It's a direct investment in his vision, his execution capability. The path is clear. Turnaround, M&A, consolidation. But it's definitely risky.
A bet on the jockey, as they say. All right, let's get into the nitty-gritty now. Announcing clearly and distinctly, Chapter 3, Financial Analysis. Let's dig into these numbers.
Okay, first, market cap. As of June 18, 2025, it's about $130 million.
Tiny compared to peers.
Yeah, firmly in microcap territory. Sunrun is what, $1.4 to $1.9 billion. Enphase is around $5 billion for solar, $15–17 billion. It's much smaller.
And even distressed Sonova is only valued around $28 million.
Right, which kind of reinforces that industry distress and maybe validates management's consolidation idea. Lots of potential targets out there.
Okay, revenue trends. This must be tricky to analyze given the history.
Exceptionally tricky. Maxon spinoff, bankruptcy, acquisition. A consistent 5-year trend is meaningless.
What was the old baseline, roughly?
Old SunPower declined from maybe $2.5 billion in 2013 down to $1.7 billion in 2023. But the new baseline for the restructured company.
Q4 24 and Q1 25.
Exactly. Q4 24 was $88.7 million revenue. Q1 25 was $80.2 million. That establishes a new annualized run rate of roughly $350 million.
And the acquiring company, Complete Solaria, saw a huge jump from this.
Incredible. The revenue base expanded like 14.7 times overnight by bringing in those SunPower assets.
Wow, okay. Profit margins for the new entity. This is key.
Very key. Q1 2025 GAAP gross margin was strong, 36%. That's healthy.
Shows pricing power, cost control.
Seems like it. But most significantly, positive GAAP operating income, $1.3 million, or 1.6%. And net income, also $1.3 million, 1.6%.
First profit in years, right.
First profitable quarter in 4 years. It's a dramatic reversal from the prior losses.
Yeah.
A direct result of that aggressive restructuring. Tangible proof.
And free cash flow. The old company bled cash.
Chronically. Negative FCF for a decade. The new management's explicit goal is positive FCF.
Are they there yet?
Very close, it seems. The cash balance grew slightly, from $13.3 million end of Q4 24 to $14.2 million end of Q1 25.
Suggests they're operating at or near cash flow break-even.
Which is a critical milestone post-bankruptcy. Shows they can sustain operations without constantly needing external cash. Huge.
Financial stability. Obviously no history of earnings consistency before.
None. But that Q1 profit, it's a critical break in the trend. It's that tangible result. It's the proof point for the new, leaner model.
What about debt? Debt to equity is weird with negative equity.
Yeah, hard to interpret perfectly right now. But total debt reported is around $142 million.
Which is manageable relative to the new revenue run rate.
Generally considered manageable, yes. It indicates the bankruptcy process did clean up the balance sheet significantly, shedding a lot of old liabilities.
And the current ratio. Liquidity.
Healthy. Between 0.94 and 1.19, that's a vital sign of near-term liquidity, especially post-bankruptcy. Suggests they can cover short-term liabilities. Stability.
And no dividends, reinvesting everything.
Correct. All focus on growth.
Okay, valuation. Trailing PE is useless.
Negative, yeah. Not helpful.
What about forward PE based on projections?
More relevant. It's in the range of 7.8x to maybe 9.87x.
Which looks cheap compared to peers.
Significantly undervalued compared to profitable peers like Enphase at 38x forward, for solar at 13.6x.
So that discount reflects the risk.
Absolutely. The market is pricing in a lot of risk due to the past, the industry volatility, the execution needed.
Now, you mentioned a DCF model, discounted cash flow, to try and find an intrinsic value.
Yeah, we built an educational one. DCF basically tries to value a company based on the present value of all its expected future cash flows. You forecast FCF, estimated terminal value, discount it all back.
Using a discount rate that reflects the risk.
Exactly. The weighted average cost of capital, or WACC.
And what did your educational DCF model estimate for SunPower?
The estimated intrinsic value range came out between $2.50 and $4.50 per share.
Which is significantly higher than the $1.58 it was trading at.
Yeah, implies substantial upside potential if the turnaround succeeds. Big if.
What were the key assumptions driving that? Must have been aggressive growth.
Had to be. We used a 10-year forecast, aggressive revenue growth like 20–25% in the first couple of years, tapering at 10–15% in years 3–5.
And a high discount rate.
Very high discount rate, WACC of 10–12%, to really account for the extreme risk here. And it assumed a long-term target operating margin of 8–10% once mature.
So putting all these numbers together, what's the story they tell?
They show a company at a truly critical inflection point. Fragile, yes, but tangible profitability achieved, break-in reached. It screams high risk, but also undeniable high potential reward.
A real knife-edge situation financially.
Precisely.
Okay, we've covered the core. Business, management, financials. Now let's look outside the company. Understand the external forces. Announcing clearly and distinctly. Chapter 4, Market Sentiment. How is the market viewing this?
Well, it's deeply divided and overwhelmingly cautious.
Analysts aren't keen.
The consensus rating from the 5 analysts covering it is a strong sell. That's as bearish as you can get.
Okay.
But paradoxically, their average price target is way higher, $4 to $4.08, with one analyst having a $6.30 target.
Wait, strong sell but price targets implying like 150% plus upside? How does that work?
It's a fascinating disconnect. It suggests that while analysts are deeply skeptical about the probability of success, given all the risks,
they acknowledge the huge potential if it works.
Exactly. They see the potential value unlock if the turnaround actually succeeds, even if they rate the odds low right now.
What about recent news flow and media tone?
It's been dominated by the turnaround story. The official rebranding back to SunPower, that first profitable quarter announcement, which was big news.
Rogers shareholder letters too, right?
Yeah.
Very confident.
Very confident, addressing the potential ITC loss head on, talking up the strategy. There was a minor blip with a late 10K filing, quickly resolved. The general media tone is kind of cautious curiosity.
Focusing on the acquisition and the cuts.
Yeah, that minnow swallows whale narrative and the aggressive, almost brutal cost-cutting.
And market indicators. Short interest.
Significant. Ranges from 10.3% to almost 12.8% of the float is sold short. That's strong, bearish conviction, people betting against it.
High days to cover too.
Yeah, 5.6 to 7.3 days. Which means if there is good news, it could trigger a short squeeze.
Driving the price up fast as shorts buy back shares?
Potentially. It definitely marks it as a battleground stock. Bulls versus bears, very clearly defined.
And technically, the chart doesn't look great.
No, technically it's weak right now. Trading below both its 50-day moving average, around $1.75, and its 200-day, around $1.87.
Indicating negative momentum.
Negative short, medium, and long-term momentum. The market's price action hasn't really bought into the turnaround story yet, still showing a downtrend.
So the market is skeptical but sees the potential upside. Okay. Let's continue understanding the forces at play by looking at who actually owns this company. Announcing clearly and distinctly, Chapter 5, Ownership Structure.
Okay. Institutional ownership.
Yeah.
It's relatively low.
Expected for a risky microcap.
Pretty typically, yeah. Around 10.4% to 13.4%.
Yeah.
And notably, many major institutional holders have actually reduced or completely exited their positions.
Names like Carlyle, Citadel, JP Morgan.
Yeah. Carlyle Group, Polar Asset Management, Citadel Advisors, Renaissance Technologies, JP Morgan Chase. Big names trimming or getting out. Reflects that institutional caution and risk aversion.
But in stark contrast, insider holdings.
Exceptionally high. Somewhere between 23% and almost 40% insider ownership.
Dominated by Rogers.
Heavily dominated by CEO T.J. Rogers. He personally owns over 8.6% of the common stock. That's worth, what, around $12.4 million even at this low price?
So strong alignment of interest there. Skin in the game.
Very strong alignment. His personal wealth is significantly tied to making this work.
And recent insider transactions reinforce that. Board taking stock.
Yeah, the board agreed to take compensation in stock. That's a powerful signal. And significant RSUs, restricted stock units, were issued to those 900 employees who came over from the old SunPower.
Vesting over 5 years.
Vesting over 5 years. A direct incentive for long-term commitment. Keep key talent. And critically, no significant open market selling by the new leadership. They're holding or accumulating.
So ownership is highly concentrated. Rogers and a few key institutions.
Highly concentrated. And notably, at the May 2025 annual meeting, shareholders showed overwhelming support. Over 95% voted for management's proposals.
Including that big increase in the employee equity plan. Potential 27% dilution.
Exactly. They authorized an additional 21.6 million shares for that plan. It indicates a patient, strategically aligned ownership base. They understand the long-term vision requires equity, possibly for acquisitions.
Interesting. So institutions are wary, but insiders and the core shareholder base are locked in and supportive.
That seems to be the picture, yes.
Okay, we're nearing the end of our analysis now. Time to really pull together the risks and opportunities. Let's turn to announcing clearly and distinctly, Chapter 6, Risk Assessment.
All right, let's do a classic SWOT analysis, starting with the strengths.
Go for it.
First, proven turnaround leadership. T.J. Rogers' track record is undeniable. Second, a powerful and revitalized brand. SunPower still means something.
Definitely.
Third, that lean and agile cost structure.
Yeah.
The 75% headcount cut, low profitability threshold. That's a huge strength right now. And fourth, a differentiated product and service offering. The Equinox system, that 25-year warranty.
Okay, clear strengths. Now the weaknesses.
First, the inescapable legacy of financial failure. Prior bankruptcy breeds skepticism. They constantly need to prove themselves.
Execution risk too, right? M&A is hard.
Significant execution risk. That M&A-driven growth strategy is notoriously difficult. Integration is key and often fails.
Their capitalization is still thin.
Fragile capitalization. That small $14 million cash balance means minimal margin for error, very little cushion. And finally, dependence on external suppliers. No in-house manufacturing for panels or batteries leaves them vulnerable to supply chain issues.
Got it. Now for the opportunities.
Big one. Industry consolidation. It's a target-rich environment for acquiring distressed competitors potentially on the cheap.
Secular growth in storage.
Definitely. Secular growth in energy storage, changing utility rates, demand for resilience, that's a tailwind. Third, potential for market re-rating. If they prove sustained profitability, the stock could re-rate significantly higher.
And innovation.
And technological advancement. Renewed R&D focus under the new CTO could open new avenues.
Okay, finally the threats. These seem significant.
They are. First, intense competition. Large national players, local installers, it constantly pressures margins. Second, global supply chain volatility.
Right.
Geopolitics, tariffs, huge risks for costs.
Reputational contagion.
Yeah, reputational contagion. If other big solar companies fail, it can create general customer distrust, even if SunPower is different now.
And the big macro threats. Interest rates.
High interest rates are a primary direct threat. Increases customer financing costs, dampens demand, period.
Geopolitical. Tariffs. ITC.
U.S. solar import tariffs are severe and immediate, hitting cost of goods sold. And the phase out of the investment tax credit. Arguably the single greatest external threat. It risks severe market contraction if that 30% subsidy vanishes. Existential almost.
So it really raises that question again. The company seems built to survive a storm that could sink rivals.
Right, the lean structure, the low break, and
But it has almost zero room to make a mistake while weathering it. A real high-wire act.
perfectly put, no margin for error.
Okay. And now we bring it all together, synthesize everything we've discussed, announcing clearly and distinctly Chapter 7, Conclusion.
Right. The investment case for SunPower, it really is a study in contrasts. You've got clear, compelling arguments for both the bulls and the bears.
Suggests a binary outcome, big win or big loss.
It feels very binary, yes.
Yeah.
Either spectacular success as a consolidator and turnaround story, or, unfortunately, complete failure if it can't navigate those external risks or execute flawlessly.
Okay, so let's summarize the bull case one more time. Why might this work?
Elite, aligned management. Rogers' track record, his huge ownership stake. Disciplined, profitable operating model. Lean structure, proved it with the Q1 profit. Clear consolidation opportunity, distressed industry, aggressive M&A playbook ready. Strong branded differentiated offering, respected name, Equinox system, 25-year warranty, and deeply undervalued stock. That significant forward PE discount to peers suggests massive upside potential.
Compelling. Now the bear case. Why might it fail?
Extreme, uncontrollable policy risk. ITC elimination, tariffs. These are potentially company killers and largely out of their hands. Intense competition and margin pressure. The industry is just brutal. Fragile financial position. Thin capital, minimal cash cushion, no room for error, massive execution risk. Ambitious M&A integration is incredibly hard to pull off, and overwhelmingly negative market sentiment. Heavily shorted, strong sell ratings. The market is deeply skeptical.
So restating the valuation summary, our educational DCF balancing aggressive growth with that high 10–12% discount rate.
Yielded an estimated intrinsic value range of $2.50 to $4.50 per share, significantly above the current $1.58 price. But getting there requires navigating that minefield.
So the concluding outlook, what's the final takeaway?
Look, an investment in SunPower today is unequivocally a high-risk, high-potential reward bet. It's a bet on T.J. Rogers successfully executing a very difficult corporate turnaround in a genuinely treacherous industry. The path to realizing the potential intrinsic value is narrow, but the payoff could be substantial if they navigate it.
So, final thoughts for you, the listener. For investors with a really high tolerance for risk, a long-term view, and maybe strong personal conviction in this specific management team.
And Rogers in particular.
Right. Then the current share price might offer a compelling entry point. It's a classic special situation investment. Multi-bagger potential is there, but for most other investors, especially those who prioritize stability, predictable earnings, lower risk, it likely looks like an uninvestable value trap.
where the low price is justified by the high probability of failure.
Exactly. The future of SunPower is balanced on a knife's edge. The outcome remains deeply, deeply uncertain.
Couldn't agree more.
Okay. Well, if you found this deep dive valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel.
And don't forget, members at €4.99 a month get priority deep dives on the tickers you suggest in the comments.
Your chance to guide our research.
And just the necessary reminder, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice.
Please conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions based on this or anything else.
Always.
So as we wrap up this deep dive into SunPower, it really leaves you with a thought, doesn't it? In these volatile markets, where past failures litter the landscape, is a company's history of distress a sign of future doom?
Or is it the perfect crucible, the fire needed for a truly resilient rebirth?
Something to think about. Thanks for joining us on the deep dive.